The alpha strategy is the active strategy where you actually take a view and you say, I believe this stock is going to go up and the other one is going to go down. So you go long the one that's going to perform well, short the other one, hoping to make money on both sides of the transaction. When most people invest, they invest in the stock market, which means when the market goes up, they are happy. When the market goes down, they are unhappy. Hedge funds are very different kinds of investments. They are called hedge funds so that investments do not move with the market. They are hedged against market moves, and so they make money independent of how the market moves. This is the main difference in terms of investment strategies. But there's also a very big difference in terms of regulation. They are much less tightly regulated, partly because the investors are much better educated, so they need less protection, which also means that hedge funds are allowed to pursue strategies which are riskier, long, short strategies, which can lose a lot of money if something goes wrong, especially on the short leg. Normal trading strategy is to invest in the market and not have a view about individual stocks or assets. Basically, all hedge funds design alpha strategies, and our model tells us how to design these strategies. So if I were a hedge fund, I would start out looking at my model and using that as the starting point for building optimal portfolios of active positions, which are long-short positions. We are basically academics, so our main objective is to help other academics understand how to construct, how to build a better model. So our paper is called The Foundations of Alpha and Beta Portfolios, which is what we provide. We hope that practitioners will use our work, but for us it's much more important that other academics build on our work. I think it's critical if academic work is going to have any usefulness. So you don't want to build a mousetrap when there are no mice to catch. And so it's very important to have a dialogue with people who are actively trading money using the kinds of models we are building. They are the best people to tell us where our models are weak, in which direction to extend them, and what is their need that academics can fulfill. So the takeaway is basically hedge funds can go home today, identify mispriced assets and construct an active portfolio, long and short these assets, which exploits optimally the correlation across these assets.